Hello everyone. Today I'm going to talk to you about how waiting to take your lump sum pension at Chevron could potentially save you over $500,000. My name is Stephen Chambers and I'm a wealth manager here at Willis Johnson and Associates. Okay, so if you were hired prior to 2008, your pension is inversely related to interest rates, meaning if interest rates go up, your pension lump sum value goes down and vice versa. A lot of people have noticed that the interest rates have spiked and thus your lump sum amount has gone down. And the question is, where are rates going to go? Well, what I want to do is take some moments to look at the data to give us an idea of what we can expect interest rates to go, where we can expect them to go. Starting with the PCE, the Personal Consumption Expenditure Index, this is the metric that the Fed uses to determine where inflation's going. And if you annualize the last 3 months of data, the PCE is around 2.5%. Keep in mind, the Fed target is 2 to 2.5%. So the PCE has been trending downwards and is actually annualizing itself close to the Fed target. That's great news. What's more, durable goods, so these are things like cars, furniture, harder assets, if you will, the prices have actually gone down in recent quarters. So we're trending in the right direction there. Some headwinds, so things that could prevent us from reaching the inflation target of 2.5 is employment, right? Some of y'all have noticed the unemployment rate is at record lows, which is great for the economy, but not great for inflation. Wage growth right now, if you annualize it, is just over 4%. And then job openings. This one's kind of a headwind, tailwind type of deal. Job openings have been trending downwards, which is great for inflation, but it's still above pre-pandemic levels. So jobs are coming in hot. That could propel inflation to be higher. So what does that mean? So the Fed gave guidance back in November of where they expect rates to go, and then most recently in December of where they expect rates to go going forward. So updated guidance. And as you can see, looking in 2024, in September, they projected rates to be a little higher than 5%. Now we're trending about 4.6%. So they've come down some based off the economic data that we're seeing. So that's good. This is a really nifty chart that just explains at a high level where the interest rates are expected to go based off the Fed's expectations. You can see in 2024, we're going to be about 4.5%, 2025, potentially 3.5%, and then 2026, just under 3%. So we're at about 5.5% now. In 1 year, drop 1%, another year, drop another percent, and in 2026, drop another percent. So obviously, things don't always go as expected, but the key point is that the Fed has mentioned that they're going to base their interest rate trajectory on economic data, and economic data has pointed to lower rates in the future. So what does that mean for you? How does this impact your pension, right? In net benefits, there's this awesome calculator that you can use to project where your pension will be at. What you could also do is manipulate the interest rate variable to determine what the impact is on your pension lump sum. So this is an example I did with a client. Inputted some variables here, retirement at 57, take the pension at 57. Adjustments to future segment rates, nil, right? We were in a different scenario where we dropped interest rates by 3%, okay? You can see here, if interest rates don't do anything, they stay where they're at, his pension lump sum is about 1.5. If rates drop by 3%, the pension lump sum jumps to about $2.2 million. That's almost $600,000 of an increase just by waiting. So the key point is we don't know what the future has in store for rates. Economic data would suggest that the Fed will start cutting rates as early as 2024. If they do that, your pension value will increase. So what we're generally telling clients at this point is if you decide to retire in 2023, 2024, it may make sense to defer electing a pension lump sum until rates have come down because the impact to your pension could be enormous. If you guys want more educational content, please feel free to follow us on LinkedIn or Facebook. And if you have any questions for me, feel free to scan the QR code here or reach out to us directly on the link below. Thank you.